Hi, this is Leo Young, founder and managing partner of Cornell Communities, a real estate investing firm helping you build passive wealth through investments backed by real estate. In this video, we're going to answer for you 3 of the most commonly asked questions. Why real estate? Why mobile home communities? And why us? So let's jump in. So let's start with why real estate. There's a few key benefits of investing in real estate, many of which you've heard of. So let's start with cash flow. When a tenant pays rent and you deduct your expenses, you get cash flow, right? So real estate produces reliable income after expenses, which offers steady inflation hedge returns that typically outperform traditional savings or fixed income products. So keeping your money in your bank account in a CD, in a bond, that yields around between 1 and 5% versus real estate, it could produce a lot more than that. Second, the big thing is tax benefits, depreciation, and there's other incentives that could create paper losses, which offset your taxable income and boost your after-tax yield and compounds your returns. So what does that mean? That means that depreciation will reduce your taxable income, keeping you more money in your pocket, which then you can use to invest in other things or just do anything other than pay the government, right? And that's how a lot of real estate investors build their wealth. Because what if instead of paying 30% in taxes to the government, you pay 0 and you put that extra 30% to, let's say, stocks or even more real estate? Then that's more funds compounding for you. Next, we have leverage. Leverage allows investors to amplify their returns by financing a portion of the purchase. What does that mean? That you can get a loan for 60, 70, 80% of the property's value. Instead of in other instruments like stocks, you can maybe get a margin loan for 50%, but that's about it. But you can get a lot more leverage here, which means you have the potential to get a much bigger reward for the amount of money that you're investing. And last but not least, this is something unique to commercial real estate. That's forced appreciation. Now, what that means is that you're able to force the value of a property to go up. And that's possible in commercial real estate because it's valued as a function of profitability. So the more profitable a piece of real estate is, the more someone is willing to pay for it. So the magic is that each additional dollar of profitability you bring to a property can yield around $10 to $20 in increased value. That's powerful. Now, there's a few different ways that you can get involved with real estate, and here's some of the most common ones. First, as you know, you can buy a rental property yourself and operate it. Now, the pros and cons to that is that you get more control, you get to learn, you could get stronger returns if you do it right, and tax benefits for yourself. Now, the cons is that typically it requires the highest amount of capital because you're coming up with a down payment, you're paying all the closing costs, you're repairing things, paying taxes, all that stuff. It's illiquid, meaning that if you want to sell it, you can't just flick a finger and sell it like in your stock account. You actually have to list it and go through the whole closing process, right? And it's not passive. You're actually managing either the tenant or you're managing a property manager. And many people find that they have to also double check the work of the property manager, which then kind of somewhat eliminates the purpose of them. Now, next, you can invest in REITs, real estate investment trust, which is kind of like a stock. You'll buy it from your brokerage account. And the pros of that is that it's super liquid. You can flick a finger to buy and sell. It's diversified, meaning that when you buy into one of those shares, you buy into many buildings, and then it has a low minimum. So shares can cost as little as $10, $20. But the drawbacks of those is that they typically have higher fees, which eat into your returns. On top of that, they have lower returns on average, and you don't get the tax benefits. Now, you can invest in a syndication or fund with us, and the benefits to you is that it's passive, but also you still get the ability to learn. You can get strong returns that beat the market, and also tax benefits. Now, the drawbacks is that there's higher minimums, typically around $50,000 to $100,000 or more. There's lower diversification because you're not buying into 20 different properties like a REIT would, and the fees vary by the syndicator. So you have to take a look at what the dollar amount is being charged, not just the percentage. That's a common mistake that people make, is that they compare percentages. Whereas if you take a $20 million project and take 1% of that versus 1% of a $2 million project, that's about 10 times difference in the fees that they charge. And last but not least, you can invest in crowdfunding sources like Fundrise, CrowdStreet. The pros is that it's also passive and there's typically a lower minimum, but the cons is that there's even higher fees, more similar to the REIT structure. They have opaque reporting. It's usually kind of vague and it's hard to reach someone for actual answers. The returns are highly variable. Some do okay, some don't do too well, depending on their strategy and when they buy, etc. And it's illiquid too. Okay, so why mobile home parks, also known as mobile home communities, manufactured housing communities, MHCs, MHPs? It's a mouthful, but they all mean the same thing. First, the biggest players love this industry. You have Warren Buffett. He owns the #1 manufacturer of mobile homes, Clayton Homes. He's the #1 financier of mobile homes through 21st Mortgage and the #2 biggest lender on mobile homes through Berkadia. Sam Zell, who some of you may know, is the founder of a REIT called Equity Lifestyle Properties. He built up a $13 billion manufactured housing REIT that has performed very, very well through the years. And he's one of the largest owners of MHCs in the country. And he was known for one thing, not being afraid to look where others won't to get the returns others won't. That's how he's been able to outperform the market. And now the other big players are coming in like Blackstone, Apollo, the Carlyle Group. You hear about it in the news, and we see it every single day. They're actually competing with us for our deals, and they pay a lot more than we do. So some of the key benefits of investing in mobile home parks. First, you supply affordable housing. Yes, a lot of people invest with the mindset of making money first and returns, and that's good. But some people forget that when you invest, you're actually allocating capital to causes that you care about. And so when you allocate capital to mobile home parks, you're supplying affordable housing because they are the lowest cost form of housing that is not subsidized by the government. And there's big demand for affordable housing, as you know. Right now, there's around a 7 million unit shortage of affordable housing in the US. And given the historic rent increases since COVID, demand for affordable housing has skyrocketed more than ever. So that increases the demand for the type of housing that we provide. Next, there's high barriers to entry. So the basic notion is that the lower the barrier to entry, the more competition there is. And mobile home parks are one of the most challenging asset classes to operate in because it's really hard to get accurate data and perform good underwriting. And there's also few vendors and property managers that actually operate in this space, which limits competition. Next, and this is super relevant right now, is that it's recession resilient. You'll see in a later slide that mobile home parks have traditionally outperformed virtually every asset class during the recessions in the past 20 years. And now with recession risk at all-time high, the compression from higher end living options like luxury housing will fuel stronger demand for mobile home parks because everyone moves down, right? When they can't afford something, they move down. And there's no cheaper form of housing than mobile home parks. Next is that there's limited supply. So there's actually a lot of restrictive zoning around mobile home parks. A lot of the governments are not approving new mobile home parks and actually knocking them down and redeveloping them for more tax revenue for them. Having the mobile home park zoning is actually very valuable because a competing developer can't just build another one down the street. And finally, there's many mom and pop owners in the space, and that's just individuals owning and operating these properties. And they've done so for 50, 60 years, and they're ready to retire. They lived a full life, and now they're tired of climbing up a ladder and collecting rents from tenants. And the benefit to us is that the way that they run things leaves a lot of operational upside. When we go in there with our professional management, we can improve the value of the property quite significantly. So all in all, the benefits of investing in mobile home parks is that it's a recession-resilient asset class. The demand for this kind of housing is really high, but the supply is limited. There's high barriers to entry and also a lot of unsophisticated operators that we can improve the value on. And also you're supporting affordable housing to the country. So next, here's a chart to show different asset classes and the returns in the past 10, 20 years. And as you see, manufactured homes are some of the highest performing asset classes in the past 30 years, and also has been the only asset class to actually gain value during the '08 recession. Why? Because people want affordable housing. When there's a recession, people need affordable housing. You'll see that in this chart as well, the growth of manufactured housing in this orange line right here compared to other asset classes. So why invest with us? First off, who is Cornell Communities? We're a team with a combined 20 plus years of mobile home park specific experience, 50 plus years of real estate experience, 3,000 units of mobile home park management experience across 10 different states. We have me, I'm the managing partner. I've been in real estate for about a decade now. Started as an investor, went into brokerage, then worked for a national real estate fund before starting this fund. Got a wide range of experiences across different seats at the table, so I know what it's like. And I was also a top regional salesperson at Tesla during a pivotal moment of the company's history when they almost went bankrupt. So that shaped my work ethic and the way that I build and motivate my team. Next, we have Dominic. He's a very experienced owner and operator in the space. He's been running his own mobile home park portfolio for the past 10 years and has about 400 units to himself. He's been a broker, investor, and commercial lender, which gives him practical perspective from different angles. And his superpower is to find and negotiate great deals for our investors. He's able to get deals at terms that nobody else can, and we pass that benefit along to you, the investor. So he manages acquisitions and also does advisory in various different departments of the company. Next, we have Larry. He runs the asset management team to make sure the big picture operations are running well and optimized, and tackling important projects like infill, speaking with municipalities, managing CapEx projects. And his background is that he used to work for a top 100 mobile home park operator where he managed over 3,000 units for them, and he oversaw a team of 30. And then we have Jackson. He manages our property operations to make sure that the day-to-day runs smoothly, and he goes above and beyond every time. This man works so hard, it's unbelievable, to make sure tenants are happy, rent's collected, the property's in a good condition, bills are paid, everything. And he's got experience running other mobile home parks for the past 5 years, and also a longer career in operations and management. So quick overview of the industry. The manufactured housing market, it's a $50 billion market size in the US, and around 20 million Americans live in manufactured homes. Like I said earlier, the supply goes down every single year due to zoning redevelopment challenges, and it's the most affordable non-subsidized housing option, with average rents around $300 to $500 per month. So the problem is that the average US home value is over $400,000, and about half of the Americans can't even afford a $250,000 home. And beyond that, rental rates have increased 20-30% since COVID. So housing costs consume 30 to 50% or more. There's very few new affordable housing options. So our solution is to provide quality, affordable housing at a compelling value, to improve community operations and give the residents a good experience, to keep the existing affordable housing stock as much as we can, and to create a win-win for both the resident and you, the investor. And now that we've proven this business model, our goal is to scale to $100 million in assets in the next 3 years. So our business model is to create land lease communities where residents own their home and pay us lot rent, to give you stable, recession-resilient cash flow in an asset that has very low tenant turnover, averaging around 5 to 7%, as opposed to 40-50% or more in apartment buildings and multifamily. And that also has limited capital expenditure requirements compared to other types of real estate, and also take over ownership from some of the mom and pop owners that actually make up more than 80% of the owners of mobile home parks. So now, how do we create value in the properties that we buy? We make it simple. We have a systematic, repeatable process to make this happen. So these are the 6 steps. First, we find and acquire underperforming communities with below market rents and operational efficiencies. Then we stabilize and we bring in our professional management. We address some deferred maintenance and improve the community. Then we normalize rents to market rates, implement utility bill backs, so there's more to enhance conservation of resources, and we reduce expenses. Then we fill the vacant lots, we add amenities, we implement community programs. Then after all that is done, we exit at the right time. We either do a refinance where we return a lot of your invested capital back to you, taking your risk off the table, or we sell to larger institutional buyers at premium valuations. And then we repeat the formula. Our goal is to turn high-earning professionals into high-net-worth individuals. So we get you there by doing this formula over and over and over again, as you watch your wealth snowball into a big windfall at the end. So quick timeline on Cornell Communities. It was founded in 2022, and over the past few years, we proved the concept, we learned the knowledge, we got the right people in place, we established the right networking. Now we hit great momentum to grow our company and grow your wealth. Our general strategy is that we target different strategic markets to mitigate the regional economic and policy risks. We focus on properties between 50 and 250 units so that it's big enough for our professional management, but then also small enough so that we're not getting outbid by people like Blackstone. We target properties with a value add component. We have a conservative approach to our acquisitions, meaning that we have cushion in our budgets, conservative assumptions, and we test different scenarios. We have multiple exit strategies to make sure we have options at the end, depending on the market conditions and the property, etc. We have vertically integrated management, meaning that we have tight controls of every step of the process, and we focus on good tenant relationships for the long term. A couple of case studies that we've done before. We have Deerfield MHC and Redwood and 1920 MHC. These are both projects that are ready to exit either through a refinance or selling it off to a strategic buyer. You can take a look at some of the return metrics here. I won't go into too much detail to sort of show you what we've done in the past. And typically we target around 15 to 20% returns. These are just a couple of examples where we beat our business plan, which isn't uncommon given our unique approach that I mentioned before. Now to go a bit more into our approach, we have a few key principles in our company. Is that first off, we put math over emotion. We don't rely on hope or hype or anything speculative. We look at numbers. We underwrite conservatively, and if a deal doesn't look good, we back out. We'd rather miss a good deal than chase a risk. Number 2 is cash flow and appreciation. we don't make our investors choose between cash flow or appreciation. We want to give them both. We target deals that have both strong in-place cash flow and also clear paths to value creation that way. And this dual focus balances risk and drives returns in any market cycle. And third is that our investors come first. We prioritize our investor outcomes above all else. So we have transparent fee structures. We don't play games with gross and net. That means we have transparent fee structures and return models, and we have clear incentive alignment to put you first before us. So if the project does well, we all win, and if the project doesn't do well, we lose first. Finally, we create great systems. We don't rely on luck. Each project has proven systems to allow us to move faster, mitigate your risk, and drive consistent execution, deal after deal, market after market. And to visualize our strategy, this is what you can expect. That we'll buy a mobile home park, we will manage the property effectively and increase the profitability, we'll distribute cash flow quarterly, then refinance to return most or all of your capital back to you within 2-3 years, and then either hold on to that property for long term to continue enjoying the cash flow or resell after 5 to 7 years after achieving the total returns. But we can also sell to the right buyer sooner if our return targets have been reached. So the bottom line is that we believe mobile home parks are one of the best asset classes in this market cycle, providing strong cash flow and returns even during a recession. We get the right people to purchase the right properties and apply the right strategy to bring value to the community and you, our investors. Next steps for you is to schedule a call with us if you haven't already, to chat with our team to see if this is a good mutual fit. We don't take on every investor, so it's important to do this, and you'll find the link below. Then after the call, you'll join our investor community and waitlist so you can learn more about the process and investing in the private markets with us and be on the waitlist for our next investment opportunity. Then when an opportunity to invest arises that matches your goals, make a soft commitment so you let our team know that you're interested in the deal. Then you'll complete the paperwork and put your funds to work for you. And very important to know that our investments are a first fund, first serve basis, just to be fair to everyone. So the earlier you deposit your funds, the earlier you secure your position. And lastly, after we close on the property, you'll get regular communication as to how it's doing and other important notices. You can track your returns in our investor portal and also just watch your bank account and watch that cash flow come in. So that's Cornell Communities in a nutshell. Thanks for making it to the end of the video. My direct contact info is right on the screen. Feel free to reach out to me or any member of my team, and we look forward to growing your wealth for you.